I agree. It is very institutionally held. We like that. We like to see that in tokens because usually it means that future token performance will reflect business performance to a large extent. Because to the extent that you have institutional holders and funds at the cap table, they'll be buyers if the token goes into an attractive kind of price area, and there'll be sellers if it kind of gets above its skis, over its skis. So you really do have this, the token really does track the fundamentals of the business, which is what we as a philosophy like to see, because more often than not, token is a distraction for teams, right?
Hey everyone, welcome to the Level Up Podcast, presented by the Medici Network, the exclusive community for financial institutions to engage with blockchain-native funds and founders. I'm your host, David Breiter.
And I'm your host, Sean Farrell. Before we kick things off, make sure to hit the subscribe button and follow us on Twitter for the latest episodes.
This podcast is for informational purposes only, and nothing herein should be considered financial, legal, tax, or investment advice. The views expressed by our hosts and guests are their own and do not reflect those of the Medici Network, Fundstrat Global Advisors LLC, Finality CP Management LLC, or their respective affiliates. All listeners should consult their own professional advisors as to the legal, tax, financial, or other matters before making any investment decision.
Now, let's get into it.
Hey everyone, welcome back to Level Up. David and I have an exciting conversation on deck. Today, we're going to be speaking with Sid Powell, CEO and founder of Maple Finance, and Felipe Montealegre, investor with Theia Research, a longtime supporter of Maple Finance. Maple Finance, in a nutshell, is a credit marketplace built on chain, suited for institutional lending. And they have had quite a couple of quarters as of late. Excited to talk to Sid about that and discuss some of the future initiatives that the protocol is working on. But would love to start our conversation today by walking through some charts and going through a brief overview of the token. If we start with the summary, this data is as of July 3rd. The ticker is Syrup. There is a bit of a backstory there. It wasn't always Syrup. We'll speak to that more in a second. But it's trading around 53 cents with a market cap of just north of 600 billion, float of around 90%. And as I mentioned, it's a credit marketplace. And so if we're looking to comps, you have your DeFi comps in the form of Aave, Morpho. But you also have CeFi comps, because it does straddle those two worlds of crypto and TradFi, carving out that institutional place in the market. And so, you do have to consider CeFi comps such as Apollo, Ares, Galaxy Digital, these other credit platforms that are, native to traditional finance. And it has generated, over 16 million in fees over the past 12 months. And that translates to almost 5 million in revenue. You see the chart, it's done, Syrup has done quite well, especially since it bottomed in mid-April.
Yeah, I think, the story here, Sean, is maybe worth kind of telling for our listeners. And kind of, dovetails pretty well with Pendle that we had on last show. I thought Pendle was interesting because they really were a comeback story. And I think that Maple and Syrup in many ways is very similar. They're a comeback story. And just to give folks some perspective, obviously there was the big wave of DeFi lending that emerged last cycle, collateralized lending with the Aaves, and that was all very successful. And then I think there was this whole wave of other lending peers that tried to find their niche with under-collateralized lending. And that, had some explosive growth, but also didn't go so well later in the cycle for many peers in that comp set. But, I think Maple and Syrup is really interesting because they've recovered since they pivoted the business model a little bit. They've gone from being unique in the sense that previously they were offered under collateralized, but now they're back to over collateralized lending. But they've pivoted to have a unique space in the market again, focused on the institutional marketplace. And then with that pivot, Maple has obviously relaunched, and rebranded the token here. And as Sean mentioned, we have the previous ticker, which was MPL, and then we have the new ticker here, SYRUP. And we've stitched these together for viewers just so you can kind of see on the chart kind of how the progression looks between the two over the longer term here. And, really there's been quite the comeback here on Syrup relative to Maple. And maybe we'll just talk a little bit about some of the technical trends. And this is really only since the since Maple rebranded and relaunched as Syrup. So that's as far back as we have on the charts. But looks like the rebrand happened maybe around 15 cents, traded down maybe as low as around, just a bit under 10 cents. And it's had quite the run in this tight channel here over the last several months, as Sean mentioned, up towards the mid 50s cent range. And we're at the bottom of the channel here. It'll be interesting to see if, Maple can hold this trend, and if, technicals can persist here, or if maybe we're losing some steam. But, it's interesting to see, and we'll be happy to talk to the team about this. And then here also, as Sean mentioned, some of the DeFi lending peers. We have obviously Syrup, EUL, we have Aave, we have Camino, Morpho, and then recently launched from the maker subDAO Spark. And then we have the comp table. Sean, do you want to tell us a little bit about some of these market comps and how we're thinking about that?
Yeah, why not? So these are all of the DeFi comps that we think are appropriate to measure Maple against. But, there certainly are, as with any comp set, some shortcomings. We looked at Aave, Morpho, Camino, Euler, Spark. These are all quite similar. You have some differences. Aave is that peer-to-pool lending, lending setup, whereas Morpho is more peer-to-peer, isolated risk type lending. But overall, it is over-collateralized DeFi lending. But you have Maple here that is a bit different in that it, takes deposits from both institutional lenders as well as, you know, permissionless DeFi capital, and issues short dated term loans to institutions. And so that's an important nuance as we go through this data. You will note that Syrup has outperformed all of these tokens over the observed time frames as 30 days and 90 days. And if we look to its multiples of fees and revenue and AUM, it's priced not necessarily to perfection, but it certainly is priced higher than these other comps. And you can attribute that to a few things. You can rationalize those higher multiples with the fact that it is an institutional product, so its customer base is very different, perhaps stickier. It has experienced some pretty significant growth that I think outpaces these other protocols over the past couple of quarters. We'll speak to that more in a second. And there is, I think the market generally has a strong outlook on the prospects for Maple going forward. And, that's something I'm excited to get more commentary from Sid on, more specifically.
Yeah, and Sean, you mentioned that the lending opportunities are more institutionally geared. This is just to give viewers a sense of some of the, what Maple will do with some of the capital, where those loans can go. They have, we're here showing a few products. They have a higher yield product, which is maybe a little riskier, some altcoins, maybe more blue chip product, has a quite little lower yields, but also, geared towards collateralized lending institutions. Then there's a BTC yield product, maybe a little lower yield. And, really products like these have attracted a lot of capital. It's been growing from several segments of the marketplace, and they have also launched several other new products. And we won't go into each and every one of them, but we'll talk about many on the pod. But I think the most important thing to highlight here is just Syrup, which is obviously you're making institutional loans on one side of the balance sheet, but sourcing of the capital can come both from institutions, and then Syrup has opened it up to get capital from the more DeFi native space, so you can take in deposits and grow the balance sheet to make those loans from this Syrup lending. And that's been a really big driver of growth in the asset base of Maple over recent months, and probably a really big driver to the fundamentals and the token price performance as well, I would assume.
Yeah, I think that's right. And, I think the reason that they've been able to attract so much depository capital is that they have high yielding loans that they issue, and as a result, been able to pass on a lot of that yield, while still netting a net interest margin off to Syrup USDC holders. And they offer pretty strong yields to depositors, especially when compared to other similar options for USDC holders looking for, or I should just say USD stablecoin holders looking for yield on their stablecoins. You can see here, this is now, to be clear, this is over all of 2024. You can see that Syrup USDC was able to garner over 20% yield, whereas some of these other products were able to produce yields at or above 10%, which is very competitive compared to things like Athena, Spark, and Aave.
Yeah, and obviously, with any market, right, rates will fluctuate. Here we have a graph, and this is from Term Finance, and they do some fixed rate lending, which is kind of interesting protocol, but they have, Aave's USDC loan rates over time, both on the borrow and supply side. And it just gives you a sense. I imagine there's some correlation here with Maple, and there's, some cyclicality to the revenue. Obviously, you can see that the market overall is kind of off of its peak, but still, it's compelling market. And again, as Sean mentioned, they've obviously been able to attract, quite a bit of deposit growth here, about 160% growth over the last quarter. And this has really taken off into, about 200% growth in active loans. So some higher utilization there, obviously. And then about 140% growth in revenue. And maybe part of that is compression due to the rates. We can talk about that on the podcast as we get into it. And then, Sean, maybe talk us through what's the actual revenue model? How does Maple translate these metrics into revenue?
Yeah, so it's a net interest margin revenue model. They take 15 to 20% of total borrower interest as revenue, and that equates to about a 150 bip net interest margin. And then on other products like their Bitcoin yield product, they'll earn a management fee, 40 basis point management fee, and then take 20% of staking yield from core rewards, which we won't get into the nitty gritty of how that Bitcoin yield product works right now. But you could just think of that as, it's a management fee type model. And so, traditional lending products, it's net interest margin. Yield products like the Bitcoin yield product, it's a management fee. And just want to note that this excerpt's from Modular Capital.
And so here we have, the earnings. And look, I mean, we'll say here, this is subject to some level of estimates. Earnings is kind of difficult to really kind of get in Web3. But, we think obviously that earnings have turned positive, and we'll talk to Sid on the podcast about how CapEx has evolved and the protocol as well. But we think that that's really kind of a key that they've, reached an inflection point for the protocol. Here was an interesting chart someone sent me that I thought was interesting. It's comparing Aave versus Maple. And obviously, Aave is much more of a behemoth when it comes to active loans than Maple, with, in the high, teens of billions versus the, maybe what, 2.5 billion for Maple today. But earnings for Maple have, turned positive, similar to Aave. Maybe that's one reason people are looking at this story, maybe not just on such of a top line numbers or such of a loan number basis, but also on an earnings basis.
Yeah, it would seem they have achieved some kind of operational leverage with their
Right.
cost
And that's
profile.
what you want to see, right, in any business. And Sean, what's going on here with the supply? There's something unique supply for Maple, right?
So, as David touched on at the beginning, they've had quite the story arc and have been around for, I think, actually launched back in 2019. And as you might guess, there's not a lot of supply overhang right now. About 90% of total supply is outstanding. Circulating is just north of 1 billion. They have no max supply because there is a tail issuance, which I believe is 5%. Correct me if I'm wrong, David. And so yeah, it's I didn't talk about it. I neglected to mention it when we were on the comp slide. But that is other interesting thing to note about Maple is that its supply side tokenomics are quite investor friendly at this juncture.
Yeah, that's right, Sean. And then a bit of the supply is also staked as well. It's been trending down a little bit since, Q2 of this year, but, there's about, say, 40% of the supply is staked. And, there's a reason for that, which is that the syrup token does a few things. Obviously, there's some governance features, but there's also some economic value accrual to syrup, the stake syrup holders, which comes in the form of both some of the 5% emissions and there's about 20% of the protocol fees go to buying back the token in the open market and then paying those fees to stake syrup holders. Now, Sean, how would you analogize this? I mean, I think in some ways it's kind of similar to an L1. Solana, they buy back and burn some, they inflate some, they pay some of that back out. But maybe it's how do you think about this economic model? I will say though, I'm not really sure I love it. I don't love the model. It's not as clean as some others, but it does, in my view, have some clear value accrual. But how do you think about
Yeah, I mean, we talked a bit about this, with the V tokenomic model with Pendle, but whenever you do this, you kind of create two different share classes, right? You have the stake syrup share class and
kind of like maybe a class A and a class B, one's dividend pay?
right, right. And so you're not necessarily accruing value to, your just average token holder, which I think is why we both don't love this model. But it does incite people to stake their syrup. That said, it's not like there's security being derived from staking syrup. So, I do have some questions over that in terms of analogizing it to an L1. But look, in terms of like a TradFi analogy, it's pretty much like a dividend. The only nuance here is that you're taking pre-costs. You're taking your gross revenues and taking the dividend from those from there and paying it out to this one class A share class. If that makes sense.
Yeah, I think that makes sense, Sean. But I do agree. Maybe it's a little wonky, but clear value accrual back to token, and that's obviously better than what you see in most protocols these days. So we'll take it and we'll talk to the team about that more. With that, is there anything else you're looking forward to chatting about as we get into the show?
No, I think Sid historically has been pretty transparent with metrics and numbers and outlook for the business, and so I'm just excited to hear more color from him on what he's seeing down the road for Maple.
All right. Well, with that, let's get into the show.
All right. Hey everyone, welcome back to Level Up. Today we're excited to be chatting about Maple Finance, a decentralized credit marketplace. Welcome in Sid Powell, co-founder, CEO of Maple, and Felipe Montealegre, investor at Theia Research. Sid, Felipe, welcome in. Sid, perhaps you could kick us off here, share a brief personal background, intro us to Maple. I know Maple has a very interesting story arc, so would love for our listeners to get perhaps a full view of that story arc.
Yeah, for sure. And thanks for having me. Really glad to be here. So my background, I used to work in traditional finance. So I was a banker by trade, and the area I worked in was debt capital markets and securitization. But that's a bit of a mouthful. So more or less what it meant is I helped lending companies to borrow large amounts so that they could break it into smaller chunks and give loans, home loans, car loans, credit card loans to their customers. And I've been doing that for a little while, and then I wanted to go into something kind of more entrepreneurial or startup oriented. So I went to a smaller commercial lending company, and that's actually where I met my co-founder, Joe. And so we were working there for a few years, and that was kind of where we hatched the idea for Maple in the background, which was more or less the initial idea was, could we do bonds, tokenized bonds on chain using smart contracts? And so we kind of kicked that off around discussing the idea or kind of fleshing out the idea in 2018. And then 2019, we just kind of plowed our own savings into it on nights and weekends, doing a very basic proof of concept. And we're able to raise money and go full time on it in 2020. And then the way that Maple actually initially began, for those who aren't familiar with us, is we were doing under-collateralized lending to market makers because we had to find a foothold in the market. And so we were doing that through 2021 and 2022. And where we've evolved to since then, because obviously there was ups and downs in the credit space, is now the core business of Maple is doing over-collateralized lending. We view ourselves as an on-chain asset manager with a focus on credit, lending, and yield. And so the key products that we now have are over-collateralized lending to institutions where we take Bitcoin or Sol or ETH as collateral, as well as a Bitcoin yield product that we recently rolled out this year, which is ostensibly a staking strategy. So that's kind of where we are today, but no doubt we can get into more details on that journey as we go.
So the protocol is called Maple. The token that we'll get to down the road is called Syrup. I got to ask, what's the deal with the pancake theme?
The way that we got to the pancakes and Maple was the idea of a debt stack. So, I used to work in securitization. We had senior debt, mezz debt, equity, which sits at the bottom. And I always thought of that as kind of like a pancake stack. And you have this other concept called the cash flow waterfall, which is you have to pay the senior guys first, then you pay mezz, and then last of all, equity gets paid. And so it's kind of like the cash flow waterfall is almost like maple syrup going over a stack of pancakes. And one thing I always encountered at the time was that fintechs would have this kind of bastardized name, or it'd be a finance word and a tech word. You chop them in half, and then you kind of knit them together, and you end up with something that's really hard to remember, hard to pronounce. And so me and my co-founder, we never wanted that. We wanted just something simple that was easy to remember and that was kind of an evocative image. And so the pancakes were kind of what we settled on. And it's also just easy to look up. It's worth noting that company that we were at had, one of those kind of bastardized fintech names, and nobody could ever Google it because they wouldn't know how to spell it. And so there's no mistaking how to spell Maple. And so we've kind of stuck with it since then. And of course we have the token, which used to be MPL, and we've now migrated to the Syrup token. So we're kind of keeping it in the same food coin group.
Love that story. It makes a lot of sense. So Philippe, that's up to you. How about you give us a bit of your background, tell us a bit about the focus of Thea, and maybe what intrigued you about Maple and led you to be a supporter.
Great, absolutely, and thank you for having me on. So my background is also in traditional finance. I really went down the investment banking, private equity path after college and worked mostly in traditional industries. So I did a lot of fig investing early on, banks, insurance companies, consumer lending companies, and quite a bit of healthcare and industrials as well. So working in things like med device manufacturing, pharma manufacturing, tire replacement, really, kind of your salt of the earth traditional companies. Mm-hmm. And at one point, me and John McNiff, my college friend, decided that there might be an opportunity to do that type of investing within the token space. So tokens in 2020, 2021 were really, all narrative driven, deciding who the prettiest, girl at the contest was, or who other people would think, it was. But there wasn't a lot of fundamental analysis and real focus on cash flow, business models, unit economics, and that type of work. So we started Thea out to really focus on what we saw as traditional investing and look for underappreciated opportunities in the space that could benefit from what we saw as one of the most interesting cash flow stories of our generation, which is the growth of internet finance and companies that profit from internet finance. We've been at it for about 3.5 years now, and Maple is kind of the quintessential investment that we look for. So there's, if we had to describe Maple's thesis for us, it's kind of bottoms up and top down. Top down, we have the whole fund thesis is looking for exposure to the growth of internet finance. We think we're going to go from, kind of 1 basis point of global financial activity to, we think 80% over a few decades. And really, that's an exciting thesis, but finding ways to play that is not as easy as you would think. Because, the question of moats, most things are not that profitable over time. Right, you really have to think about the business economics. You have the question of like value accrual to the token and whether teams really respect the token as a prime value accrual instrument. And you have the question of execution, which has been quite hard to nail down in the industry. And Maple really hits on all of those questions. We've known the Maple team since we started the fund now, and they've proven over many years that they're committed to the industry and growing and building a really unique product in the industry. 2, committed to token holders and treating token holders as the main beneficiaries of their growth and profitability, which is quite rare. And 3, proven that they can build a business with moats that actually becomes profitable and generates retained earnings for shareholders over a long period of time. And we'll get into all that during the podcast. But I guess, at a high level, there's kind of 2 ways to invest in the growth of an industry. One is to invest in the pipes and the infrastructure. If you were investing in the U.S. financial system and its growth, that would be things like SWIFT, Visa, BNY Mellon as a custodian. or two, you can invest in people using the pipes to make profit, right? And the analogy there in the internet, in the US financial system would be investing in JP Morgan, Bank of America, Wells Fargo, Goldman Sachs. And we think that most people are focused on the first category, not the second. We like both, and Maple for us is kind of the quintessential investment in the second category, investing in people using the pipes to generate a profit.
Yeah, I think that makes a lot of sense. And that's a really helpful thesis for framing it. You know, maybe I'll just kind of go to the product and kick it back to Sid and just kind of talk about, I mean, I don't want to say a bank, but like any, organization with an asset liability balance sheet that earns income from that. Can you maybe walk us through kind of the sources of capital on the deposit side, the different buckets, and then the loans or where you put that to earn return, and how that kind of what the product mix looks like and how it's evolved?
Yeah, for sure. Just to kind of start at the high level and then drill down. So we manage around 2.5 billion AUM today. So it's up more than 10x year on year. But what does it look like as a business, and what does that translate to as a business? The closest way to think of us is almost like an alternative asset manager. So I'd say the closest TradFi corollaries to us are not necessarily just banking, which of course has at call deposits. It's probably somebody more like an Apollo or an Ares, in that you can have a maturity to your liability side, the capital coming in. And so we have today about 3 product lines. First is Maple Insto, where we take in money from accredited investors. And what will happen is that they will deposit money into one of our lending pools. And then we, as the kind of central underwriter, will turn around and lend that to institutions. So we take in stablecoins. We then originate loans on chain to institutions, which is over-collateralized by large cap crypto assets like Bitcoin, ETH, Solana, XRP. And an interesting point, which I'll come back to, is that we're kind of a hybrid of DeFi and CeFi, in that we take a lot of that collateral into centralized custodians. Second product is it's the DeFi distribution version of that, which is Syrup USD. And this is integrated, so it's permissionless access. It's not available in the US, but it's available to retail offshore as well as protocols who can just directly deposit to it. And so that's been a powerful lever for us in establishing relationships and integrations with teams like Pendle, Morpho, the Spark team, Camino on Solana. And then the third product is BTC Yield, where we run a staking strategy. If I look at those as kind of composition of our business, the Maple Insto side, about, call it, 400 or 500 mil of TVL. Syrup is about 1.6 to 1.7 bill of the TVL, and then you have the BTC side making up about 150 mil of that TVL. But what we do in our business model is we take the funds lent to us, and that comes from high net worths, family offices, hedge funds, corporate treasuries, and foundations. And then we turn around and we originate a loan. And let's say I lend at 8% against 150% collateralization of Bitcoin, and then we take a percentage of that interest. So that's how we make our money. We take a spread on the interest, and then we pay out the remainder of that interest to the folks who have given us money. So not dissimilar to an asset manager like an Apollo or an Ares, and a little bit different to a bank in that we don't try and what we do is not asset liability maturity intermediation, where banks take at call deposits and loan them out for 30-year mortgages. We are really trying to take deposits for a certain amount of time and then lend them out for kind of a matched amount of time to our clients.
Walk us through, you get money from institutions. They probably have a different standard in how they want to think about the risk. And custody, there's been a lot of issues with custody. Maybe talk about some of the structural processes with how that works.
Yeah, for sure. And so just to contrast us from, a more entirely on-chain protocol, like say an Aave or a Morpho, what happens there is that a user, like a borrower, would be permissionless. So they take a wrapped asset, so a wrapped version of Bitcoin, they put it in a smart contract that will manage the liquidations, and then they take out a loan from the pool. In our case, what happens is that a borrower will come to us with a request for a loan. We'll negotiate commercially, and so we'll kind of set what we think is a reasonable rate, and then we'll also determine the amount of collateral they need to post. So obviously, Bitcoin gets the most favorable treatment. something like an XRP or a Sol, a bit more volatility, so we're going to be a bit more conservative. When we settle and kind of agree terms with them, they'll put the collateral either with us directly, or they can put it in a tri-party account with a custodian. What that means, and why that's a bit of a competitive edge for us, is that a lot of institutions are holding native Bitcoin. They don't want to wrap it. And so their finance and compliance teams kind of view wrapping an asset as potentially taxable. So they just want to hold native Bitcoin. And so we're kind of the only sort of, call it DeFi or hybrid lender who can accept the native Bitcoin. And they might not want to put it in a smart contract either. So they can put it in a tri-party account at an Anchorage or a BitGo or a Zodia or a Coinbase custody, and then take out the loan from us. So structurally, we're using, or they and us are using the tri-party accounts at custodians to kind of reduce the counterparty risk. They view them as safer than using smart contracts to house their collateral, because Anchorage has a $500 million insurance policy. Aave doesn't necessarily have that, or Morpho might not have that, right? And so they view that as a way to reduce their counterparty risk, and they can use native BTC without having to wrap it. So we have to be conscious of the kind of the counterparty risks there with the custodians. But what we try and do is spread our assets across multiple custodians so that we have some kind of, so that we have a degree of diversification there. And then one other thing is our loans will typically be open term with a 30-day recall period. So that's how we mitigate the asset liability mismatch risk. We're not out there doing 2-3 year loans with deposits that can be recalled in 30 days. So we always have we always have like quite a large amount of liquidity in the book so that we can meet redemptions. And I think that was one of the issues when you look back at 2022, right? A lot of those firms, Celsius, BlockFi, they had at call deposits. They needed to be able to return them in a day. And their loan book was, had duration built into it.
So do you think, for listeners or people who've been in crypto, or people who are just on the outside who've seen the whole Celsius blow up, or some of the the prior under-collateralized players have issues. Do you think that those are kind of the key issues? It's the underwriting and then the custody. Is there anything else you would point to?
It's certainly a mix of those. If you look, I don't think any lender had one key thing that caused their default. It was kind of like a mixture of factors, which came down to sometimes they were accepting illiquid collateral or indeed no collateral. And I think one of the issues was they had the book was commingled. So they had one entity that had a bunch of over-collateralized loans that might have actually performed quite well. And then they had loans collateralized by liquid stuff, or stuff that had, let's call it phantom liquidity, like an FTT token. And then they had loans that had no collateral at all, but they had them in the one entity. And so the people who were giving them their funding had a misrepresented view of what the risk was. They didn't think they were investing in a book that was partially under-collateralized. They thought that the entire thing was over-collateralized. What we've tried to do is we on the Insto side, we actually segregate the two strategies we run out of that entity, or out of those entities, apart. So we have one that's just pure BTC and ETH. It's the most conservative thing we do. And then we have one where we can accept Sol, XRP, other tokens as collateral. And we very explicitly say this is higher volatility collateral, but you're getting paid a higher yield for this. We don't do under-collateralized lending out of that entity. And if we were to do under-collateralized lending, we would park it in a separate entity and make it very clear that that's the risk profile. So I think, just to come back to kind of the core question, it was a mix. So the collateral and the underwriting there, as well as when you get into teams, businesses like Celsius, there was obviously other stuff at play, like they were taking the assets and deploying probably more of it than was warranted into DeFi protocols for yield farming. Whereas with our idle cash, we just deploy it into kind of very conservative money market type strategy. We're not out there playing yield farming games. And I think that's another element for transparency. People should know exactly what they're getting exposed to, and have the option to choose their risk preference. And then the other thing is we're very clear that we're just sticking to over-collateralized lending here. So we're not going to dabble in the under-collateralized lending space, and we're not lending against super liquid assets.
Yeah, that's great. And Felipe, maybe to you, you've seen this Web3 lending space evolve over the years. Maybe at a high level, how do you frame this market, the different options, and then kind of where, Maple fits within that.
Yeah, and so on the lending side, I think there's kind of two axes that really differentiate the options. One is the DIY platforms, the do-it-yourself platforms like Aave, Morpho, Euler, where the investor needs to be sophisticated and build the product they want for themselves, which is a reasonable option. And the other is kind of the white glove service, where I would put Maple, where the investor, where the borrower is getting the solution given to them to meet their needs, right? So you hear Sid talking about, tax treatment for Bitcoin versus wrap Bitcoin, talking about custodians and making sure the custodian mix is appropriate. That's all stuff that Maple is doing for their customer base that the DIY platforms are not doing for you, right? You have to think about your own tax treatment. You have to think about your own risks and set up your own product for the most part when you're working with Aave, Euler, Morpho, which are all great products, but kind of service a different customer need. So I would say that's one axis, right? The other axis is fixed rate, fixed term versus variable rate, variable term. And for the most part, all of these options, Aave, Morpho, Euler, that are in the DeFi lending space are variable rate, variable term because they need to be in order to keep the asset liability match appropriate, right? As soon as you have, variable assets and fixed liabilities, you get into problems with asset liability mismatch that will, eventually blow you up if you're not managing that actively. And again, Maple is kind of alone in the bucket of actively managing that asset liability mismatch and being able to provide a responsible fixed term, fixed rate borrow experience. I'd say those are the two main categories. And in both, what you see is Maple really counter positioning the competition. So when the DIY platforms all compete with each other, but if you really want somebody to do something as basic as giving you a margin call, right, before liquidating you, Maple's your only option. Or if you want to, borrow for 30 days to match a strategy, Maple's really your only option at scale in the market.
Just to add to that, I think it's worth noting that margin call point is actually pretty important for the institutional customers. So if they were to be on one of the DeFi platforms, there's no margin call. You just get liquidated, and your entire collateral gets nuked in that margin call, right? Or the liquidation. And there's penalties involved. That's actually where the protocols make a lot of their revenue, is on those high liquidation days, because they're charging a spread on the liquidation. Whereas with us, we actually don't really want to be liquidating our clients. So when we give them a margin call, they've got 12 to 24 hours typically to post. But we reach out, we send them email notifications or reaching out on Telegram. And 99% of the time, our clients are posting. So since August 2023, when we did the first over-collateralized loan, we've only had one partial liquidation. And there we only liquidate a portion of the collateral to get back to their initial LTV. So it's very borrower friendly, and we're not then charging a big spread on that liquidation. So it's much more friendly to institutions, and that's actually a major selling point for them, because a lot of them, it's career risk if you take out a loan as a PM at one of these firms and you get liquidated. You're basically fired at that point.
Yeah, I think that makes a lot of sense. On that topic, perhaps that's a good opportunity to maybe just talk through how in practice, I know you've just said you have a great track record regarding, underwriting and a lack of liquidations, but how does that process work? How do defaults work in practice, especially on the deposit end of things?
So let's start with just a kind of hypothetical vanilla loan. So our standard is around 70% LTV. So think of it as roughly you're posting about 140. Let's say you post $145 of Bitcoin and I give you a $100 loan. That's our starting LTV, 70%. And at 80% LTV, so as the Bitcoin drops in price and hits 80, I'm giving you a margin call. And at that point, you got about 12 hours to post. And so you can either post more Bitcoin to get us back to 70, or you can pay down your loan. So either way, we're getting back to 70, either through a reduction in the loan or an increase in the collateral. At 85, so if you either didn't respond for the 12 hours, or during the 12 hours, the price of Bitcoin has continued to drop and you've hit an 85% LTV, at that point, we're selling. So if it's in a tri-party, we would send a note to the custodian saying, okay, we're taking control of the Bitcoin now. And then we would send that either to an exchange or to an OTC desk to liquidate it. Or if it's just if it was just pledged directly to us, then we're doing the same thing. We're sending it to an OTC desk or to an exchange. But we're gonna liquidate them back to the initial LTV. We're not gonna nuke the entire thing unless it's a very illiquid type of collateral, and we're concerned that there's going to be too much price slippage. But you can see, 85% LTV. You've got that entire buffer from 85 to 100 to protect our position for price slippage, and then in the event that there were a shortfall still, because the prices just dropped so dramatically, we actually still have recourse to the borrower's balance sheet. So if it's a fund, we still have a claim on the other assets of the fund. If it's a corporate treasury, we still have a claim on the other assets of the treasury. And that's kind of unique in another way that we are set apart from the DeFi apps, which are non-recourse loans. So if they were to lend against some form of illiquid collateral and there's a shortfall at the end, the protocol in the DeFi app has to eat that loss, whereas we would still be going after going after the borrower and claiming that from the rest of their assets. So it's just an extra form of protection for us.
One quick thing on David's question I think is interesting is the white glove, I guess, human element also lets Maple underwrite more creative loans, because if you are a money market platform on a particular VM like EVM or SVM, you're limited to the assets and tools that exist on that VM. But if you're Maple, you basically are one level above the stack. So you can use any VM, but you could also use the legal system. So for example, I know, Sid, that you do quite a few XRP loans. There's a lot of demand for that. There's not really anywhere to meet that within EVM or SVM because XRP doesn't live there. But once you go up the stack and you're able to use the legal system, you can offer that product. Go ahead, Sid.
I was just going to say that's a perfect example. So, even though all ostensibly 99% of Maple's loans originated on Ethereum, we've been able to accept Sol as collateral. We've been able to accept XRP as collateral. And from time to time, we've been able to do something like a Pendle PT token where we're comfortable with the risk. So we can be kind of more creative and bespoke. And so that's why typically, hedge funds who are trying to run yield strategies will often come to us as their first call, because we're going to be able to either give them a go or a no-go on a deal fastest, and and kind of give them a creative solution. We can either up the price or we can lower the collateral. Because we're not one size fits all, we can actually capture more of the, call it more of the market.
Sid, you guys have launched some products recently that have been kind of innovative and have really helped your growth. Maybe talk about some of the ones that are the most important drivers that have been over recent months, and then maybe are there any hints you could give on future products that you're really excited about as well, they think could create growth?
Yeah, for sure. So I think the biggest driver of our growth over the last 12 months has been Syrup USD. And so that was the permissionless version. So early last year, we had Maple Insto, and we had the blue chip pool doing ETH and BTC back lending, and then we had the high yield pool, which would do things like Sol and XRP. But we were really missing out on the wave of capital in DeFi. So you saw the explosive growth of things like Athena and Pendle, and we needed to get a foot in that market. And so we launched Syrup USD, which is the permissionless version of the same institutional over-collateralized loans under the hood. But what it meant was initially we were able to get it listed on, or have secondary liquidity for it on Uniswap and Balancer and some of these dexes, which meant people could get instant redemptions. So we've been able to kind of gradually solve some of the pain points for our customers in the Insto product using Syrup USD. So we got it secondary markets. Secondary markets then meant it could be liquidated. And so then that opened up the integrations with Morpho and Euler, and now there's a temperature test and a vote going on with Aave to accept Syrup USD as collateral there. So we're able to then get it onboarded as collateral for the big lending markets. And then the other partnership we had that was really fruitful for growth was Pendle. So people could, because we had a pretty stable high interest rate on the product, folks would use Pendle to fix the interest rate. So then that integration allowed people to either fix or hedge or speculate on the interest rate there. So that was another important one. And then we had the integration with Spark, who now deploy over 400 million into that product as a source of yield for their ecosystem, because they want to be, the Spark Sky ecosystem wants to be kind of the central bank of DeFi. And most recently, just to kind of finish up on that product, we were able to then get it cross-chain. So because it's permissionless, we could bridge it to Solana and have it integrated as collateral for the Camino lending market over there. So now cross-chain is kind of pushing the next leg of growth for Syrup USD. And the thing that we're really interested in is getting it accepted as collateral for perp sticks, which I think is one of the big growth. Perps have been one of the breakout products of this year with success stories like Hyperliquid. And so we'd like to see it onboarded as collateral for that. And then the other products has been obviously the BTC yield product. So we've seen a lot of pent up demand for BTC yield, because a lot of folks, there hasn't been any good way to earn a return on your BTC or a yield on your BTC. And so we introduced the staking product in partnership with Core DAO, which is a Bitcoin L1. And where we want to progress that product over time is more integrations with custodians and centralized exchanges, but also producing running the same playbook we did with Syrup USD. So getting a liquid, permissionless, tokenized version of that can then be pushed out onto lending markets and other chains, so you can earn a yield on your BTC while you post as collateral. So I know that was kind of long-winded, but I would say Syrup USD and now applying the same kind of playbook to the BTC yield product that we have, whilst continuing to push Syrup USD adoption.
I think it's interesting that you said that you let Syrup trade on like Uniswap, for example, because like today, timely, if you saw the Bloomberg article about JP Morgan and private credit, the private credit funds were trying to box out the trading debt, JP Morgan, so they don't have the marks. DeFi were already doing that, right, with the transparency in private credit. I thought that was pretty cool. Maybe, I actually have two last questions for Felipe, and then we can maybe go to the next kind of topic. One, Felipe, do you use the product? And then two, how big is just the market and where Maple is within it?
We do not use the product because we don't take leverage as a fund. It's one of our kind of core principles as a directional fund. If we were a yield fund, that would be very different, and we'd be active users. But as a long only directional fund, we really try to stay away from leverage in this industry. On the market, I think the economic model, the underwriting model, is quite simple with the business today. You have you have outstanding borrow, right, on the borrow lend side times NIM, and then you have the assets under management on the asset management side times the management fee, right, incorporating both management fee and incentive fee. So, the loan market today is a bit above 10 billion. I'll have Sid give his latest estimate of the number there, but you can easily imagine a $50 billion loan market on the fixed rate loan side over time as the industry develops. That would be just slightly above where it was a few years ago when the BlockFis of the world were underwriting. And then the way you think about that flowing down through the revenue is you have the loan market Maple share, $50 billion loan market, 20% Maple share as an example to peg, a future outcome would give you $10 billion loan book for Maple. Again, that's, I think a reasonable outcome given the growth we've seen over the past few months. With a 1.5% NIM gives you $150 million of revenue from the loan side of the book. So I'm just kind of going from the top down to what you can see as a bull case for Maple on the P&L side. On the asset management side, this is one that's harder to handicap because the actual market size is so large. If you just think about the amount of Bitcoin held by institutions or the amount of, digital assets held by institutions in general, but it's kind of sky's the limit there on market size. So I'll just give one example, right? Sid's gone from zero to close to $1 billion in less than a year here. At $5 billion with a 50 basis point management fee, 50 basis point incentive fee, you're looking at 50 million of revenue there. If I kind of put those together, you're looking at like a kind of a reasonable path to $200 million of revenue. I'll ask Sid for what he thinks the operating expense would be there, at most 50. So $150 million of earnings. You can kind of look into the future and see how Maple can get to $150 million of earnings with pretty reasonable assumptions and in a reasonable amount of time. So that's kind of how I see the market opportunity. I think the execution until now has shown that might be a conservative case, just given how quickly Maple has grown over the past year and how much we expect the underlying market to grow going forward. Does that answer your question, David?
Yeah, I think so. Go ahead, Sean.
I think that was a great breakdown, Felipe. Earlier, you talked about you drew comparisons between Maple and the offerings in DeFi and some of the variable rate lending that is available. But throughout this conversation here, we're talking about integrations with Pendle and custodians and whatnot. It seems more similar to centralized credit lending marketplaces, right, that are integrated with custodians and interest rate derivatives desks. I guess, how do you think about the advantages that Maple has from a product perspective compared to incumbent centralized lending desks? Is it the efficiency of crypto rails? Is there something beyond that?
I think that there just aren't many firms living on the edge here. And that's really the beauty of what Maple is doing. They, as you mentioned, they went through all of the advantages they unlocked for SERP USD by being on-chain native and understanding that you can put some more for an Euler loop. You can put it on Pendle so people split out the PT and the YT. You can create a pool and use swap for instant redemptions. That's all on-chain native thinking and kind of masterful use of the on-chain tools that I know that kind of CeFi lenders aren't comfortable working with. And on the reverse side, we talked about underwriting, asset liability match, custodians, KYC. I think we haven't hit on, but it's a major point as well. It kind of shows masterful use of the CeFi tools that the on-chain native audience doesn't really have. And I think that the beauty of Maple is really one of the only teams, and this is a major point. Sid operates a team of 30 people, most of whom are bankers working late and kind of sophisticated people who know how to use these tools. It's one of the only teams living in that edge between the two worlds. And that means you can use the tools from both sides to win deals and provide a better customer experience for everybody.
Yeah, and so just to double click on that, as an investor, when assessing the competitive moat and the durability of said moat for Maple, is it that residing on the edge, that and being at the forefront of offering these products that the centralized lending desk will not? Is that the source of their moat?
So I'd kind of split it up into two categories of moats. One is the go-to-market moat, like how do you win business? And there, certainly being on the edge, is a form of counter positioning where nobody else is doing it. There are good reasons why it's very hard for on-chain native protocols to go CeFi. It's very hard for CeFi desks to go on-chain. So Maple's counter positioning, that allows it to win deals and grow quickly. And I think there's also on the go-to-market side an economies of scale moat where they just have a big team of bankers. And for the most part, I really am hesitant to say that a team is a moat in any kind of situation. But many people may not know this. There is a real scarcity of sophisticated, TradFi-minded people in the space. So building a team of 30 people who can think about these deals and structure these deals is genuinely hard. I think it's hard to even hire 5 people like that. So I think that's a real moat for the foreseeable future in terms of Maple being able to take share, go-to-market moats. But those won't last forever. I think the kind of forever moats, the ones that will really help Maple's profitability be higher than competitors over a long period of time, is one, brand really does matter in lending. Sid said it is career risk whenever you lend to a protocol. It's career risk, and we've seen very sticky market share numbers in lending, in DeFi. We also see it in CeFi because of the brand trust issue, right? you don't get fired by lending to Aave, to kind of on the pure DeFi native side. You do get fired for lending to, XYZ upstart for a higher yield and losing all your funds. That's a, career risk fireable offense. So smaller players really need to be a much higher yield in order to be considered above the kind of trusted brand name. And we think Maple is growing into that, and already is that name for people, for its customer base, where Maple is a secure brand that you lend to, and you feel safe that you're not going to take career risk by lending to Maple. And God forbid, in the case where there is a problem, all of your peers also experience the same problem, which is it's just the way these lending markets work, right? Then you have network economies too on the asset management side and on the lending side, right? As an asset manager, the more capital you have, the better deals you can negotiate. So Maple's already in a much, much better situation when they're negotiating deals on the asset management side and kind of crafting these bespoke deals than somebody who's an upstart with $10 million or $50 million of AUM, right? Because you're trying to win the Maple capital. You're not trying to win the upstart capital. So you're giving them the better terms. And these are kind of so brand and scale, where you kind of tried and true moats. At the beginning, Sid talked about Apollo and Ares, so the better comps. I talked about Goldman Sachs and JP Morgan. All of these are institutions that have really benefited from scale moats as they've grown to keep stable market share and stable profitability over time.
So Sid, and I think this builds on Philippe's point. I saw you had this Cantor partnership, obviously the Wall Street investment bank. And as Philippe mentioned, the brand and then the talent and what it takes to cross over. How did you strike that deal? What was that conversation like? And what is that exactly? And how is that evolving? Like, how are you getting capital from them?
Yeah, sure. And just one point to add to kind of Philippe, the points Philippe made before. I think it is a very durable element that really we're not seeing any appetite from any of the CeFi lenders that we work with or that we comp ourselves to go and attract capital from DeFi. Like, I think that's a very firm line in the sand for them that they won't cross. And that's actually been the source of much of our capital growth in AUM over the last 6 months. So I think that is, that diversified sourcing of capital is a real distinct advantage that we have. Now, just to turn to the Cantor question. So obviously very established, strong Wall Street brand. And so the relationship that we have with them is that we borrow. So they expressed middle of last year appetite to lend against Bitcoin. They obviously have a very strong relationship with Tether. And so we borrow wholesale from them, and then we originate smaller size loans. So they want to be a wholesale provider of finance in the market, and we pledge Bitcoin to them. So it's a collateralized facility. And are able to borrow in size from them. So that really kind of falls within that Maple Insto product line, where we are trying to do more to bridge TradFi investors and asset managers to bridge them with the DeFi space. And what that looks like is we're going to seek more of these kind of wholesale funding relationships from large institutions that have big balance sheets. And over time, that will help us get our cost of capital down. So as we get more funding partners and can demonstrate a track record of working with firms like Cantor, we'll be able to borrow in larger size and at cheaper rates. But the conversation with them, they obviously have a very sharp team. And so it was, 6 months of due diligence and kind of working through the onboarding and the structuring and what the terms would look like. But, we're very happy to have a relationship with them. And we think that their entry into the space really portends strong tailwinds for other TradFi firms coming into, crypto-backed lending. We think it's going to be a huge growth sector over the coming years as Bitcoin's market cap continues to rise. And the top-down approach I would look at is, as Bitcoin's market cap continues to rise, what portion of that will want to borrow against the Bitcoin? And that's kind of how I look at sizing the market.
Maybe that's a good segue to talk a bit more about the economics of the business. You mentioned trying to get your cost of capital down over time by sourcing, these wholesale sources of capital. What does your current cost of capital look like? I'm curious. and what does the what does the yield being paid out to lenders look like, or I should say depositors? What yield are you are you offering to, or interest rates are you charging to borrowers, and how does that net interest rate margin look like right now across the board?
So to talk to our kind of financials at a high level, like our revenue run rate at the moment is around, call it like high 11s to 12 million. And that comes from the net interest margin. So we borrow conventional lending business model. We borrow at a low rate, we lend at a higher rate. And so for us, the cost of capital differs between our products. We have the blue chip pool, BTC and ETH-backed lending. We have the higher yield one where we pay out more, so higher cost of capital there, and we pass that on to the borrowers. And then we have Syrup USD, which is a lower cost of capital because we're able to tap DeFi capital sources. But looking at each of those in turn, roughly blue chip, we pay out around 6.5. So 6.5 kind of cost of capital. We charge, about 1.5 to 2% more than that on the loans. And then high yield pool is actually paying out a very strong yield to lenders at the moment. It's about 10.1. And so that's the cost of capital. And then we charge about 1.5, again, like 1.5% on top of that. And then Syrup USD has the lowest cost of capital because it's now the most scaled. So this gets to kind of what we've been talking about with economies of scale. Our cost of capital on that is around 6 to 6.1%. And again, we're charging like roughly 7 to 7.5 on that. So we charge a slightly smaller NIM at the moment because we are, we're kind of in deployment mode and grabbing a bit of share. And then the rough cost run rate for the business, we're starting to experience the kind of the operating or financial leverage coming through as we hit profitability in April. And roughly we spend around 7 to 8 million annualized per year, mostly on staffing costs and developing our software. But we crossed profitability in April, and now we're at around about a 12 mil revenue run rate. So we're starting to see the kind of the profit of the business expand as the book expands. But yeah, cost of capital is around that low 6s.
You mentioned origination and management fees. What do those look like?
We charge a platform fee of around 25 bips for kind of infrastructure costs. And then we typically don't charge much in the way of origination fees. So mostly we're getting our economics from the NIM. What will happen though is that as we get larger, we actually have a couple of quotes out or proposals out for more like tranched securitization facilities. And as we do that, we're going to be starting to charge more origination fees. So that could be, something like a 50 basis points to 1% of the facility size up front. So if you do a 100 mil facility, you're charging about $1 million in upfront fees on something like that. But that's almost more investment banking type revenue, but that'll be a new revenue stream for us as we start to do those types of facilities. And that's obviously good for the business because you take all of that upfront.
And when it comes to matching, both sides of the loan book, how do you guys manage sourcing capital via Syrup? Obviously you mentioned it's open and permissionless. So how do you guys toggle supply and demand based on what you're seeing on the loan side, what you're seeing on the loan book?
The answer is you're always kind of pedal to the metal on getting capital in, because that's ultimately the inventory that we use to grow the business. So we don't really want to slow down there. We'd only slow down if we saw like an acute shortage of places to deploy, because if you end up with too much capital, it kind of pushes worse credit quality. But how we've managed, trying to get more supply in through the Syrup side has been, from August last year, we ran a points program. And we actually ran that in a very cost-effective way. I think one of the PMs from CMT Digital put out a good post on it, but we effectively spent less than 1% of token supply to raise, 400 plus million in TVL for it. So it ended up being pretty cost-effective, and that was done as a points program with partners like Pendle. Now, what we've been doing is pushing the cross-chain integrations. So we've used kind of like almost like a B2B2C approach, where we try and establish a partnership with a team like Camino, and then their users deploy into Camino pools that will loop through Syrup USD. And then relationships with teams like Spark, which is almost an enterprise sales type approach. So there is a lot of BD involved in growing Syrup, but we try and work through partners, whether it be Spark and Sky or Pendle or Camino. And the other thing we've done recently is do kind of campaigns with centralized exchange wallets. So there's a huge amount of stablecoins sitting on centralized exchanges like Binance and OKX. And we've actually worked with the wallet teams from those exchanges to allow their users to deploy into Syrup USD. And we think that's going to be a huge growth driver for us for the rest of the year, because those relationships takes many, many months to get through due diligence and establish the relationship. So it's not like an upstart competitor of ours can go and do that tomorrow and be integrated with a Binance wallet or a centralized exchange earn program. So I think that's definitely one of the distribution channels that we're leaning on to grow Syrup USD for the next 12 months.
Great. I think we have a pretty good understanding how the business works. Maybe let's talk about how this all flows back to the token. And, maybe I'll just stick with you for now, Sid. Can you maybe give us the very quick history of Maple, MPL, and then Syrup, and then let's talk about what role it plays?
I'll give you the kind of the abridged version. So the original token was MPL, and this had a fixed cap supply. And this became a problem once we went through the bear market, where to keep the protocol going, we had to do a raise at the bottom of the bear. And this depleted the last of the tokens in the DAO. And so we needed to increase the cap. And we weren't able to do that with the fixed supply. So we were going to have to migrate the token. We took the opportunity to rebrand the migrated token, call it Syrup. And so we completed that. We actually initiated that migration process in November of last year, and then it wrapped up in May. And so 6-month window for people to migrate their tokens to Syrup. Now we just have Syrup. Syrup's the one governance token of the entire protocol, and it participates in the growth of the network through a buyback mechanism. So we take at the moment about 20% of the protocol revenues. We use that to buy back Syrup token, and then we distribute the repurchased Syrup tokens to people who are staking. So it's like a buyback and distribute model, where if you stake Syrup, you participate in, receiving the bought back Syrup. So you get a yield on it. One point to note, we don't have an equity entity. So unlike a lot of teams out there, we don't have a conflict between, the equity entity that has a claim on revenues and the token holders. So core team members are large holders of the tokens. All the previous capital raises have been through the token rather than an equity entity. And so it's our view that it's the token that should benefit token and token holders who should participate in the growth of the protocol, rather than an equity entity kind of siphoning off revenues or having an adverse set of interests versus token holders.
So just so I understand the flow, like you have, maybe 100 million of gross interest income to all, you, and then you have to pay out, let's call it 80, just be round 80%, for example, and you keep 20. And then let's say that's like, maybe 15 million, maybe 12 million, something like that, doesn't matter. And then 20% of that goes to buying back Syrup.
The token. Yeah.
The Syrup token. And then that'll get paid out to the stakers. And you say you don't have an equity entity. What happens to the other 80? That just goes to cost, or will that increases as revenue scales faster than your cost structure? Or like, where does that sit? Does that sit how?
The reason we had the 20 was because, up until April, the protocol wasn't profitable. So we set it at a conservative level, and that was done through a vote of token holders. So what happens is, on a quarterly basis, token holders can vote to decide how much to pay out. And as the revenues of the protocol scale faster than the cost, then you can see that percentage increasing from 20 to maybe 50. Maybe one day it's inverted and you're actually paying out 80% as kind of buybacks. But what then happens is the tokens are repurchased, and then they're streamed to people who are staking the Syrup token. So it looks like you're getting a scrip yield effectively. But yeah, because previously we were not profitable, we were doing at a conservative 20% level. But over time, let's say you had 100 million of overall overall interest paid, and then your 20% of that is net interest, so 20 mil. You could see a world where you're paying out 10 or 15 million of that to buy back the token and then distribute that to the stakers. Any amount that's not repurchased, so we are funding OpEx, of course, but the other thing it could be used for is reinvesting in the growth of the business, which in my mind would look like maybe we have to put up first loss for another wholesale facility when eventually, JP Morgan does a wholesale facility against Bitcoin. And so then it's effectively being reinvested in the growth of the business, still sits within the structure, but is being used to generate more revenue.
Philippe, from your perspective, what are your thoughts just on their economic model versus others?
On the token side,
Yeah.
it's perfect. I mean, Sid and Joe all have always been. I mean, one, I'll say they've proven their commitment to the token, which is rare because they had a true trial by fire after the end of the last bull market, where every business in lending and kind of DeFi went through a major drawdown, and most people abandoned the token or decided under extreme stress to somehow remove value from token holders as a kind of escape valve for problems. And Sid and Joe did not do that. They behaved extremely ethically towards token holders. Part of that is because they're token holders themselves and own a decent part of supply and treat that as their main value accrual mechanism. But part of that is just shows the way that Sid and Joe and the team think about token and have kind of respect for it as respect token holders as partners in this enterprise. So that's on the qualitative side. I think it's very important to say anyone can say nice things. Actually going through a trial by fire and proving your commitment is something else entirely. And Maple is one of the few projects that has gone through that. On the other side, I think the main things that we care about that they on the token side are, one, that there's no other value sinks that compete with a token, right? So no equity entity is the main one. No second token is another important one. Again, Maple hits on both of those. Other teams would have considered launching another token for X, Y, or Z new product, right? Like most products that the Maple is earning money from today are not products that were contemplated, a few years ago when they started the business. So they've proven time and time again that new products all go to the same token, and that's important. And then on the distribution side, I think it's great that you guys are doing buyback and distribute, Sid. But I think because you have these kind of protections, no equity, no second token, team is paid team is compensated in token, team is raised in token. Because you have those protections, we kind of defer to the team on how much they want to retain and how much they want to pay back. We don't want to meddle in that, because the thing is, our favorite thing is seeing the team retain a lot of earnings and use that for growth, and that's what Maple's been doing. But it's also quite nice to see them grow out of that and see the operating leverage come in and see a lot of earnings just kind of flow through the token holders. But that we're more indifferent there. Once the structure is right, if we're backing the right team, we really defer to them on what percentage goes to buyback versus what percentage goes to retained earnings that's reinvested in the business.
I think about it as just to build on what Philippe said. I think kind of the North Star, right, is like over time you should be kind of increasing earnings per token. In the same way that like equity markets kind of focus on earnings per share. So there's a couple of ways you can do that. You can obviously grow your core earnings. A lot of teams are doing buybacks and burn, where they kind of reduce the denominator, so they reduce the float of token supply. You can do either. And over time we may look at like a buyback and burn model if we think that's kind of an efficient use of capital. And then as for uses of capital, we basically just stack rank it. It's like if we can redeploy in the business and generate a higher rate of return than repurchasing the token, then we would keep a lower, do a lower buyback percentage. But if we think the best use of capital is kind of repurchasing the token, then that will kind of go to the top in terms of uses of capital. But we're always trying to kind of evaluate what is the best kind of use of it from the perspective of the token holders.
Can we just spend a little more time on like the actual supply dynamics here and talk about how much of the syrup is out? I guess like maybe half of it staked, what the growth is, who owns it.
So when we did the migration to syrup, there was a one-time mint of 10%, and then there was inflation of 5% per year for 3 years. So the total kind of fully diluted supply will end up somewhere around like 1.25 to 1.28 billion tokens. 93% of that is circulating. So everyone, all prior OTC rounds, the majority of team vesting is out there. And so there's not a big, supply cliff hitting the market anytime in the future. And what happened as part of the migration is there was about 7.5% of the tokens that were not migrated. And so that's going to go to the treasury as a kind of reserve that can be used for either liquidity or for growth of the protocol. So things like whether it's a rewards campaign or partnerships or, liquidity for the centralized exchange venues and market makers, but all ostensibly to kind of help the growth of the protocol. We have staking, and we have around 40 to 45% of the token supply staked at the moment. So I've covered kind of supply dynamics, inflation, the holdings of the treasury, and kind of the amount staked. It's actually pretty largely institutionally held. So I think, I know of a number of funds who kind of hold between 4 and 10% of the token. And so it's relatively, it's kind of it's more of a relatively institutionally held token, I would say, than kind of a retail held token. And then also the team continues to this day to kind of retain a large portion of it from, initial vesting that has never been sold. The initial distributions, because I know people kind of think about that, was when the token was originally minted, it was around 25% allocated to team. There was about 26% for the initial OTC round, about 14% kept for treasury, 5% in an initial public sale, and then 30% for kind of, call it ecosystem growth, liquidity mining, that sort of thing. But now, given that it's been out for 4+ years, most of that is kind of now in the hands of the public. And, I think that is one of the interesting things we have is that, 90+% of the token is out there. So there aren't those kind of big, you don't have that kind of low float, high FTV unlock dynamic that I think is very damaging to a lot of other projects.
So just echo everything that Sid said. I agree it is very institutionally held. We like that. We like to see that in tokens because usually it means that, future token performance will reflect business performance to a large extent, because it's, to the extent that you have institutional holders and funds at the cap table, they'll be buyers if the token goes into an attractive kind of price area, and there'll be sellers if it kind of gets over its skis. So you really do have this, the token really does track the fundamentals of the business, which is what we as a philosophy like to see, because more often than not, token is a distraction for teams, right? And if you can just make it so that the token just directly follows kind of the core KPIs that drive the business and core profitability, that's the ideal setup. And that's what we think Maple has today.
As we're coming up on the end of our conversation, it's probably a good time to focus on some more forward-looking stuff, talk about catalysts, perhaps some risks from the investor side of things. Sid, going to throw this question to you. What upcoming upgrades, catalysts, milestones should investors be aware of right now?
It's a good question, Sean. So our target on growth for the end of the year that we've been public about has been 4 billion TVL. And we're roughly earmarking around a target of 25 mil revenue at that milestone. It's going to be from a mix of Maple Insto, Syrup USD, and the growth of the BTC product. I'd say my only shift in kind of how we've estimated that will look at the end is I'd say we're probably going to revise upwards Syrup USD growth, because that's had a tremendous amount of momentum. So I think that'll be a larger share of the 4 billion. That's already over 1.5 billion in TVL today. Big milestones for us. We're going to continue to push out Syrup USD across cross chain. And so I think that'll be a big growth lever for us. So we've launched on Solana. I think that's been tremendously successful. We saw 50 mil of inflows from that. We're pushing out onto other ecosystems. And then also centralized exchange integration. So we're looking at trying to get it in the mix of those exchange earn programs. And I'm very bullish on that. I think that's sticky capital. Those are durable relationships. And so I think those are going to be tailwinds for Syrup USD. On the BTC yield side of things, the catalyst will be continued growth of that staking product, but also what we're going to do is run that same permissionless play. So get an LST version of that token out and get that integrated with DeFi protocols. And then on the Maple Insto side, it would be more of those Cantor-like facilities for us. So I think we're seeing, particularly the catalysts have been, Genius Act, so general acceptance of stablecoins, market structure bill coming. You're going to see increased crypto investment appetite from traditional asset managers, and that's going to make them more likely to do business with folks like us and provide funding to our fixed income products. So I think that's going to be the tailwind that will drive that product forwards. So overall targeting 4 billion, we're looking at around 25 mil target revenue kind of by the end of the year. And so I'd say those are the main catalysts.
That's great. Is there an estimated timeline for that Bitcoin LST?
We're working on having it, call it, within the next 3 months. So I think we'd like to have something by Q3, but it's obviously, or rather before the end of Q3. But kind of famous last words when you talk tech deployments, you kind of set yourself up to fail. But that's certainly what we're working towards, is get it deployed in Q3.
I think it's great, Sid, that you have some guidance for the end of the year. Have you guys given is there any high level you can give for next year on guidance? Or is that maybe a little too?
It's probably a little bit too premature for it. I mean, we've all been in crypto for a few years, and you see how much it fluctuates, and so you can end up way off. I think we try and just kind of show up and steer the ship each day, and so I would be looking to see growth accelerate in 2026. Is kind of all I would say based on those tailwinds I mentioned. But yeah, I'll probably just hold shy of giving exact figures yet.
I think that's great, but I actually want to kick it to Felipe now. We have some guidance from management. What do you think? What are you thinking on kind of the next end of year and next year, Felipe, based on from that guidance?
We have learned over time to trust Sid's guidance, and expect a little bit of upside to it, just because working with him long enough, truly understands the business, knows the drivers, and tends to follow a under-promise, over-deliver mentality. So I can't do much better than, I think it'll be a little bit better than Sid thinks, or Sid states.
So on the catalyst side, you think there's positive earnings surprise in your view then?
We just got the surprise right now, right? They're revising it upwards. But generally that's my mentality with the team. The major risks of that are really things that I kind of see as relatively low likelihood in this market environment, right? One is it's a market-driven business. So Maple needs the market to be out there, and it needs the market to grow, which I think with the current kind of political landscape and regulatory landscape, we should see growth for many years in this side of the market, right? Just BTC borrows and activity on chain. So that's kind of one major risk that I don't think will materialize. A second major risk for Maple hitting earnings would be, the inability to design new products. It is, on the asset management side, a product-driven business. And again, I just don't think that that's a real risk given the creativity we've seen from Sid and the team, right? The BTC yield product was kind of, one good example of that. Syrup USD, LS BTC, like LSD BTC, those are all good examples of how the team can continue to innovate, and push out dozens of innovations a year, basically, in terms of growing the business. And the third risk I'd see to hitting earnings is any kind of hiccup on the asset liability side. which can be a real issue for these businesses. And again, I see how focused the Maple team is on that particular question, having kind of been the or one of the sole survivors from the 2022 meltdown, and having this so ingrained in the culture, where I just don't think we'll see any hiccups on the asset liability side. I think they're very tight there. So to some extent, the projection is an extrapolation of the growth we've seen over the past year. The only thing that could derail it would be one of these risks, and I think they're all well mitigated right now, given management.
Sid, what about you? What are you paranoid about?
A lot of things. Only, to the title of the Andy Grove book, only the paranoid survive. And so I think you want to always be kind of preparing for the worst in this business. In a lot of ways, a lending business is kind of a loser's business, as in it's like loser's tennis, where you're trying to avoid unforced errors rather than strive for home runs. And so I think about, to Philippe's point, it is a cyclical sector. So we have to be careful about not extending credit on poor terms. So accepting like illiquid collateral or going at like too high LTVs. That's probably the day-to-day thing that is worth calling out, that might get overlooked in kind of a lending business. And then, like market shocks, obviously we're not immune to things like tariffs and geopolitical shocks. So I try and keep an eye out for that. We try and staff the team at all times to be able to do margin calls around the clock when things like that comes up. And then the other thing is I think of competition, right? Like I think we have to be constantly disrupting ourselves. So this year we launched the BTC yield product in February. At the same time, we actually launched a structured, kind of like almost like a structured note type product, where we gave people exposure to up to 33% yield if BTC were to rip. We timed that totally badly though. So BTC then went sideways to down, and so we didn't see any uptake for that product. But it shows that I think we have a commitment to trying to design new products and not just like resting on our laurels. And some of those products won't work, but we're going to try it. We're just going to be quick to call out if it's working or not, and then kill it if it's not working. And the other thing I think is distraction of focus or dilution of focus. I think too many teams maybe try and launch 10 products at once without fully exploiting. You're always going to be treading the line between exploration and exploitation. And I think, some teams maybe try and launch 10 products at once when they should just be focusing on what's going really well and just trying to ride that wave. So I think making sure that team has focus is something that I know Joe, my co-founder, is very, very good at, and that I try and do as well. But it's something that we try and instill as a team, and instill in them as a co-founding team is just let's focus on what we're doing well and what our biggest opportunity is, and not get distracted by new shiny things.
I think that's great. Probably should have asked this earlier, but you mentioned structured products, and you guys tried launching one. Is that something that investors should contemplate when thinking about your P&L, 5 years from now, as an entity that will offer structured products to the market?
I think we will eventually. I think structured products, I just look back at TradFi, right? And I see Morgan Stanley and JP Morgan, the private wealth businesses there, sell a lot of structured products to high net worths. And you need to look no further in the space than Sailor's products with strategy, right? So the two kinds of pref equity, the convertible notes and convertible bonds, I think they hint that there is actually a lot of untapped investor appetite for structured products. I think we just timed the launch of the first one we did not optimally, but I wouldn't close the door on doing those in future. I think if we found that there was investor appetite and allocator appetite for it, we have, this is one of Philippe's points, we have all the bankers on the team, right, who can structure those things. So it is within our wheelhouse to do something like that. And I think as the space matures, there's going to be more demand for structured products, and so we want to be there to meet it. So yes.
Great. Now, I think we could probably wrap things up here, but I do want to give both you guys just a few seconds to offer some parting thoughts, or maybe opportunity or sources to learn more about Maple or Thea. So maybe we start with Philippe. I don't know if you have any parting thoughts or key takeaways for our audience.
Just rehash that. I think we really appreciate the Maple team. Again, they've acted ethically and have respected token holders the entire time. It is very rare to find that in the industry. They're a competent team that thinks in terms of return on capital, cost of capital, risk, all of the things you want to see in somebody managing a capital business, which again is very, very hard to find. And finally, they understand that the on-chain tools are tools that you can use to create novel products and kind of meet customers where they are. And again, I think that's also hard to find. People kind of treat it as like build it and it will come software, or ignore it altogether. And having somebody who can manage both sides and kind of say, we have this wonderful new suite of tools. Let's bring it to customers. Let's bring the horse to water here and give them what they want is incredible. So just want to reiterate our appreciation for the team here.
Great. And Sid?
So I think for anyone wanting to find out more about us, so we're pretty active on X. So at Maple Finance, I'm at SyrupSid. And then we do run a blog on our website. So it's available at maple.finance. There's an insights page, and we try and put every quarter we put up a treasury report, which has the finances of the business. So we try and have that kind of transparency. And then we do a token holder call at least every month where we'll kind of talk through the latest developments of the business. And you can just tune in on X to see that. So that's usually me and my co-founder talking through the kind of fundamentals of the business. And then I'd say that the kind of the tailwinds for the space are the things I'm just paying attention to. So I think private credit is the fastest growing sector in traditional finance, and really where kind of what we're trying to do is see that flourish on chain. And then stablecoins, I think, are going to have a really, explosive hockey stick moment in terms of outstanding supply. So we're at 250 billion at the moment. And I think, you're going to see dramatically more DeFi and on-chain asset management activity when we hit 1, 2, 3 trillion there. And that's I think where stablecoin supply is going off the back of the Genius Act and the kind of the regulatory accommodation that we're seeing in the space.
Well, I must say, I think SyrupSid might be one of the best Twitter handles I have heard in quite some time. And with that, guys, thank you so much for coming on. It's been a really fascinating and interesting episode. Thanks a lot, guys.
Thanks for having us, guys.
Thanks for having us.
It's a pleasure.
That's a wrap for this episode of Level Up, where liquid token protocols meet the sharpest minds in institutional investing.
If you found value in today's conversation, don't forget to subscribe and share it with your network.
For more deep dives into blockchain's most compelling projects, reach out to us or follow the Medici network for more insights. Until next time, keep leveling up.